So let's get started. We'll talk about some details. We'll talk about a little more in detail about reorganizing the balance sheet here. Okay, and we are reorganizing the balance sheet again to so that what we're left with is a pseudo balance sheet that only contains the operating assets and the operating liabilities of the firm. Right. What we want to do is look at the accounting balance sheet and remove any non-operating or financing items. So that's going to include most of the debt, most of the liabilities, and most of the owner's equity, and then a handful of the asset side. So we're not recreating a balance sheet, so to speak, because what we're going to be left with is not going to balance. The operating assets and the operating liabilities are not going to balance, or at least it's unlikely that they're going to balance. So unlike with our reorganization of the income statement, we're not going to end up with something that looks like what we started with. Okay, so all we're trying to do here is walk through the balance sheet and identify the things that are operating in nature, both on the assets and the liability side, and then we're going to get rid of everything else because we're going to value or interpret all of those other items separately at the end of our DCF analysis. Okay, so the way that we reorganize the balance sheet, and we looked at this a little bit in Chapter 8, and we talked about it a little bit in our example problem, but the way that we reorganize the balance sheet is by starting with the balance sheet identity, which says that assets have to equal liabilities plus owner's equity. And then what we can do is we can separate the assets into operating and non-operating assets, and we can separate our liabilities into operating and not non-operating liabilities. We would call it operating and maybe financing liabilities, or operating liabilities and debt. Okay. So we now we make a new, we just sort of reorganize that initial balance sheet identity into the same identity with different terms here. The operating assets plus non-operating assets should equal operating liabilities plus debt plus equity. And then we can just subtract operating liabilities into the other side, and we can create the terms that we're interested in here. Okay? So operating assets minus operating liabilities, that's what invested capital is equal to. Okay? So if you are trying to calculate the firm's invested capital, you need to identify all the operating assets and all the operating liabilities, and then subtract the liabilities from the assets. Then if we add the value of the non-operating assets to invested capital, we get something called total funds invested. And the reason this is called total funds invested is because these three terms are equal to the financing that the firm has received, the firm's debt plus the firm's equity. So total funds invested is, again, the identity is not true because we want it to be true. It's true because there is economic reasoning behind it. The firm has raised all of its capital from debt or from equity. And then it has used all of that to buy operating and non-operating assets and then operate the firm. So total funds invested comes from debt plus equity. That's why it has to be equal to debt plus equity. Okay. Now, we have looked at reorganizing the UPS balance sheet in our DCF example. Here's another just sort of really simple balance sheet that we can use to get another example of how this works. Right? So here's a simple balance sheet. It's just got 2 years, the prior year and the current year. On the asset side, we have cash, inventory, net PP&E, and equity investments. And that gives us our total assets. On the liabilities and equity side, we have accounts payable, interest-bearing debt, and retained earnings. Okay? So the balance sheet balances here as we expect. Again, this is pretty straightforwardly laid out so that we can try to identify. But what I want you to do right now, just quickly before you pause it and before you move on, try to ask yourself which of these are operating assets and which are non-operating, and then on liabilities, which of these are operating liabilities, and then which of them are debt or equity. Okay? And then come back and check your work. Again, hopefully this is straightforward. I want you to see some different examples because this is what your third homework is all about. I've given you several different examples of balance sheets and income statements, and I want you to reorganize those statements into NOPLAT and invested capital. So you have to take this seriously, and what you got to do is just walk your way down, just like we did in the DCF example, walk your way down and ask yourself, does the firm need this asset in order to operate? And then, does the firm use this liability as part of its normal operations, or does the firm use this equity as part of its normal operations? So we start with cash, and we say, okay, does the firm need any cash to operate the business? And the answer is clearly, of course, yes, it needs some cash. Now, what we know from our DCF example and our discussion in last week's lecture is that, of course, it doesn't always need all of the cash it has to operate. I mean, we can see, even in this example, that the firm got by with $5 million in cash in the prior year and is now holding $15 million in cash in the current year. Now, there are a number of reasons for that, right? Maybe we determined that $5 million in cash wasn't enough and we were having cash shortfalls and we needed to take out short-term loans or use credit cards to sort of cover that. So we decided to hold more cash in the current year. But it also could just be that we made a bunch of money last year. We are holding some of that money as precautionary cash because we think things are going to be economically rough in the future or something like that. But also it could just be that we have extra cash that we haven't determined an appropriate use for. And so we are going to consider some of the current year's cash to be excess. So the firm needs some cash to manage its operations. It may not need all of the cash it has. And so what we would say is that some piece of cash, what we call operating cash, is going to be necessary. And then some piece of cash, what we call excess, would not be necessary. Okay? So we will specifically talk about this in a couple of slides, how to determine this. Inventory. Well, inventory is all the product that we have on hand that we haven't sold yet. So, of course, we need our inventory to operate because we're trying to sell this product that's sitting in our warehouse. So this is part of our operations. Net PP&E, again, just like what we talked about in the DCF example for UPS, for the most part, we have to consider net PP&E to be operating in nature. This is our property, plant, and equipment, and those are all the things that we use to operate the business. We might have office space in here, we might have warehouses, we might have machinery, factories, trucks, computer equipment, whatever we need, it's all included in net PP&E. Now, it is possible, of course, that some portion of net PP&E is non-operating. Right? The firm maybe has an old location that it's renting out to somebody else that they are not using, that still is considered our asset because we still own it, but we're renting it to someone else. If we can identify that, then we should remove it from net PP&E and, just like cash, create an operating PP&E and a non-operating PP&E. We would have to be careful if we do that to then make sure that we can identify the revenue being generated by that. Say that, let's stick with the rental example. So we have an old building, it's worth $50 million and we're renting it out. Right? We're not using it. If we can identify that, then we can take our current year's PP&E and we can say operating PP&E is $300 million, non-operating PP&E is $50 million. This is our warehouse we're renting to someone else. However, if we do that, we must then be able to identify in revenue where that rental revenue is coming from, right? So we would then need to separate out from revenue. We would have operating revenue, and then we would have non-operating revenue, and hopefully that would be called rental income. And so we would have to make sure that that is separately listed in the income statement, or that we could identify what that value is. Because if we include something or don't include something in our calculation of invested capital, we have to do the same thing in our calculation of NOPLAT. Otherwise, we're going to be having a discrepancy. Okay, so, but again, that's a sort of usually a long shot. For the most part, all of net PP&E is operating. Okay? Equity investments. This is stock that the firm owns in other companies. And again, unless the firm is a stock broker or a bank or a stock buying company, then equity investments are not part of the firm's operations. They're just alternate investments, things that the firm has used. Maybe they've made an investment in a subcontractor, or they've made an investment in a supplier so that they own a stake in the supplier. and this is their reporting of those assets, but those aren't operating in nature, and so that is a non-operating asset. On the liability side, accounts payable. Well, accounts payable is money that we owe our suppliers. We bought supplies on credit. That is part of the normal operations of the firm. We're borrowing money from our suppliers on a really short-term basis so that we can get supplies and make the product that we're selling. Interest-bearing debt is not operating, it's financing. So it's not that we don't use debt or any kind of loan to operate the firm, but it is considered a financing measure, and so we are going to account for that separately. Retained earnings, this is money that we are saving. This is part of the owner's equity side. This is money that we have earned in a previous year that we are keeping and reinvesting into the firm. And retained earnings is not included as an operating item because it is sort of like additional financing. Okay, so this is the more or less the firm's savings account, and it's included in other items here. So we look at the reorganization and we see exactly as we discussed, the construction of invested capital comes from a reorganization here. And what we're going to do is just separate the operating from non-operating items. So first, we'll look at what we call operating working capital. So we'll take all the current operating assets and current operating liabilities, and that's cash and inventory minus accounts payable. That's our operating working capital, current assets minus current liabilities. Only, of course, it's operating current assets minus operating current liabilities. Then we'll have our fixed assets and any minus any operating long-term liabilities. That would be net PP&E. We don't have any operating long-term liabilities in this example. We did, for instance, in the UPS example, so we would subtract those. And then the addition of net PP&E minus any long-term operating liabilities plus operating working capital gives us invested capital. Okay? So invested capital is all my operating assets minus all my operating liabilities. And here I just sort of separate that into two steps so that we have our current ones separate from our long-term ones. Okay? Then total funds invested is my invested capital plus any non-operating assets, and the only non-operating asset we have is equity. We have invested in stock, equity investments in other companies, so we add that to invested capital and we get what's called total funds invested. So that would equal here 465 million. Notice that that's not equal to either total assets or total liabilities in the original balance sheet. Okay, so that's not what this is trying to represent, but it should represent the value of all of the debt and all of the equity that is on the balance sheet, because that's where the funds from total funds invested came from, right? The only way the firm gets money is by raising it from debt and equity. And so we can reconcile this calculation of total funds invested with the debt and equity from the balance sheet. And so we notice that this is equal to interest-bearing debt plus retained earnings, which is our debt and our equity respectively. And that is equal to total funds invested. Okay, it has to be. That's where the money came from. The firm is either using its savings account from retained earnings or interest-bearing debt to fund its purchase of operating assets and liabilities, and then using that to run the firm. Okay.